Joining us now is Joe Brusuelas, chief economist at RSM. Joe, I can't think of a better person to have this conversation with on this latest inflation reading. A lot was hanging on to this. I want to get your initial reaction. We have the government reporting that CPI coming in, the headline number 2.7% year over year, 0.3% month over month. But let's get right to core. Core 2.9% year over year, month over month, 0.2%. It's the fifth month in a row of decelerating core, although still you couldn't call it tame yet. But what are your thoughts? What's your reaction?
I think the initial reporting on financial television is a little bit over optimistic. I got a chance to open the data, look beneath the top line. You know what I see is tariff-induced inflation in apparel, in furniture, and appliances. It's exactly where one would expect to see inflation moving after large tariffs being put on Chinese imports. So we're actually beginning to see what we thought we would see here in June, with the more major increases occurring in the July, August, September, and October data. Now, with respect to the top line, 0.3%, spot on, 2.7%, actually above expectations. When we turn to look at the second set of inflation later this month, remember, inside PCE, demand-driven inflation is really what's been driving this modest increase that we're beginning to see take shape in the slope of inflation. Now, that tells me the Fed's not done yet, but we're going to have a really interesting discussion today around whether the Fed should cut 25 basis points at its September meeting, or more likely what we think is you won't see the first cut until December 2025 at the earliest.
Joe, let me ask you this. I know before this print, you'd had a prediction of inflation rising above 3% this year. Do you still have that viewpoint coming off the back of this?
Without a doubt. Again, once you open the hood and look at the inner workings of the data, you can see this, although I am somewhat encouraged by service inflation, which is now only up 3.8% on a year ago basis. Housing inflation still a bit hot at 4%, same with shelter. That critical owner's equivalent rent, now that's really important in policy world. Many of your traders may not even follow that closely, but the owner's equivalent rent's up 4.2% on a year ago basis. Even food and beverages is creeping higher at 2.9%. You know what? I got a sense here is other economists, strategists, traders actually move beyond the knee-jerk response to the headline. They're going to begin to see what I'm seeing here in this detail, and we're going to get a second-order reaction, I think, here by midday.
Let me ask you this, Joe. You described the current environment as stagflation-light, citing slowing growth, rising inflation, and a tolerable increase in unemployment. What is the biggest misconception that you think that markets or investors have about the current environment?
I think that they're expecting a bit more of a bigger fiscal boost out of the tax cut. You know, we're at full employment. You're just not going to get a bolstering of overall economic activity that one is used to from this sort of fiscal expansionary policy. So my sense is here by the end of the year, you're going to see an economy that's growing around 1%, but you're going to have PCE top line, and that's the variable the Fed uses to set policy, not core CPI, not core PCE. That'll be at 3%. CP top line PCE will be around 3.5%. So that to me tells us that for at least for the foreseeable future here for the rest of the year, we're going to have stagflation-light, probably be the best description of the overall economic environment.
What about the job market? How do you feel about that? In terms of the data that we looked through recently, it shows that the job market is still holding up. Do you have any concerns there?
Not particularly. I mean, we're going to, hiring is going to slow, and it's going to slow a little bit below 100,000, which at least for the time being is the number we need to hire each month to keep employment conditions stable. You know, an unemployment rate between 4 and 4.5%, I'm not really concerned about. What's going to be interesting, though, going forward is as immigration policy gets tighter, supply to the market will shrink, will actually contract. So there's going to be an effective ceiling placed on just how high the unemployment rate can go. What will happen is sometime mid next year, maybe a little bit earlier. We'll make a reassessment and then we'll say, well, because of immigration policy, because I mean, really, we've just cracked down completely. We may be stepping up the pace of deportations here very, very soon. That we're only going to need to make to create around 50,000 or so jobs per month to keep employment conditions stable. So what we'll want to watch is wage growth and see if it just flattens out, or on the back of that tighter immigration policy, it starts to creep up and we start thinking about second order conditions or wage induced inflation. But that's a little bit ahead of us. But for now, I'm not really concerned about a real big increase in the unemployment rate or a significant slowdown to zero in monthly hiring.
Joe, I want to go back to the point you made about seeing some of the trade effect show up in apparel, furniture, and appliances. You know, I know that you point out that trade policy is essentially fueling some of it's a key drag in terms of your outlook that you have. How concerned about the ongoing volatility that we have around trade policy, especially as it pertains to, say, the latest being Mexico and Europe, could trigger, reignite your inflation expectations or just long-term growth impact?
Well, there's two things. One is the trading and investment environment. I'm worried that we're in a period of real complacency here now, where no one thinks that these threats are actually ever going to be implemented. Therefore, equities just drift higher. And this is separate from the very strong bank earnings data that we're seeing, where a steeper yield curve is driving better net interest margin. Good trading conditions over the past 2 months really bolstered bank earnings, at least early this morning. My sense here is that I am somewhat concerned if the effective tariff rate moves higher than 20%. Now, right now, it's about 11%. I think it's going to settle in somewhere between 15 and 17 when all is said and done. Now, if you're closer to 10, we can adjust to that. The economy will just roll on, albeit at a slower growth rate, with a little bit of higher inflation than we might like. Now, if we end up with 20% plus, then we're going to be having a very different discussion. But for right now, the market is optimistic. It's driving a bit more complacency than what I'm comfortable with. But I think that's going to be a good description until we get back to the week after Labor Day.
Okay, yeah, no, there are others who share that viewpoint about the complacency in the market and this kind of continual grind higher. Joe, we'll have to leave our conversation there for today. That's Joe Brusuelas, Chief Economist at RSM. Thank you so much, Joe.